Hi, this is a presentation from the Duke Financial Economics Center on Private Equity 101. I'm Chris Wade. So private equity is an industry that has emerged over the last 30 or 40 years. It really started in the 1980s when a couple of the first private equity firms rose as investment funds. And what they figured out was how to use equity capital and then also debt capital to buy and sell majority stakes in companies and generate higher returns and have more control over their returns than you could by investing money into publicly traded shares of companies that traded on a stock market. And where private equity is fundamentally different than public equity shares is that, again, you're buying a control position in the company. So what that means is that you have control over who the management team is, what mergers and acquisitions are done, and what the strategy of the business is, as well as control over the capital structure. So really get to control a lot of the key aspects that drive the value of a business. So this emerged as a new asset class and was very attractive to a lot of the big pools of equity capital that are out there that need to grow large amounts of money over a long period of time, over 10, 20, 30 years. And these big pools of money that are out there that we show on the left side of the slide here are largely people's retirement money. So these are pools of money that are coming from pension funds. A lot are for government employees. Think, firefighters, teachers, other types of government employees, people of that nature here in the U.S. And then recently, there has been a rise in the activity of sovereign wealth funds, like I show on the bottom here. So, for example, one is the Abu Dhabi Investment Authority. That's a sovereign wealth fund for Abu Dhabi. These are typically funds from countries that have made a lot of money, often selling natural resources, and they're now trying to invest that money, again, over a long-term time horizon for the benefit of their people. So these big pools of money that are out there that are just trying to grow money over a long-term time horizon are looking at ways to invest, and they'll buy a lot of public stocks, bonds, debt and company to grow over time, but then will invest in private equity as a smaller percentage of their money as well, since it's emerged as a pretty high return asset class. So these people write big checks to private equity funds, which are known as the general partners. So they aggregate equity checks from the limited partners, and then they use that money to buy controlling stakes in companies. And they do that by using their equity capital and then also a lot of debt capital as well. So with that, they have a lot of buying power. And again, this industry really started in the 80s and has grown a lot since. So a ton of companies that you probably know are owned by private equity firms. You probably don't go through a day without using a product that is made by a company that's owned by a private equity firm. So how does it work? What does a private equity firm look for in an investment? So private equity firms typically buy controlling stakes in companies for between 3 and 7 years, and then they sell the company after that time period, hoping to sell it for more money than they bought it for originally. And a key component of this is these private equity firms will use a good amount of debt to buy these companies. So in order to make sure that they can make their interest payments and pay back the debt, the first and foremost characteristic that private equity funds are looking for are stable cash flows. So when these companies take out debt, they owe a percentage of that amount in interest every year. So these companies need to be cash flow positive, generating cash to support the debt. And starting on the math of how private equity works, so the way most people think about purchase price when a fund buys a company, they look at what is the annual cash flow of the business, and then we'll apply a purchase or entry multiple to that cash flow, typically somewhere between 5 and 12 or 13 times the cash flow of the business, which again is a wide range and depends on how attractive the company is, how much it's growing, how fast the market the company's in is growing, and things like that. But that's just a quick way to think about how to start to think about valuing these businesses. So again, when private equity funds make these investments, they're buying a majority or all of the company. So they're controlling all the major decisions that are made in terms of the capital structure, who's the CEO, who's running the business, what's the strategy, are they going to do acquisitions, sell parts of the company, all these things that impact the value of their investment. And again, the goal is to hold a company for typically between 3 and 7 years and then sell the company for more than they bought it for. So again, you can think of the exit sale price as what's the annual cash flow of the business 3 to 7 years later, and then what's the multiple of that cash flow that they're selling the business for. So it's a relatively simple framework and highlights the 3 ways that you can make money in private equity. You can use the cash flow of the business to pay down debt, which in turn increases the equity value of the equity side of the capital structure. You can grow earnings or the annual cash flow amount so that it's higher when you sell the business, or you can increase the multiple at which you bought the business. So if someone pays you a higher multiple when you exit, you'll have made money by improving the purchase price multiple. So what's an example of how the math works in practice? So again, it's really only 3 main areas where you can zoom in and see how you make money on a private equity investment. So starting with the initial purchase, let's say a private equity firm is coming in and they want to buy a company with $10 million in annual cash flow for about 10 times, for about a 10 times multiple. So they're buying a company for $100 million. A typical structure for that might be $40 million of that is equity that the private equity fund is writing themselves, and then they may borrow $60 million in debt. So let's say they hold the company for 5 years. Again, the business is generating about $10 million in cash flow every year, but a good chunk of that will have to go to pay down interest, some maybe to invest in the business. So let's say they're able to take $30 million of that cash flow to pay down debt. So assuming no other growth in the business, no change in multiple, that the company sells, that the fund sells the business for the same $100 million they bought it for, they will only now have to pay back $30 million in debt upon exit. So that $40 million in equity that they bought the business for will have grown to $70 million. But the second step, over those 5 years, hopefully the business has been able to grow. Let's say things went well and they were able to grow that $10 million in cash flow to $15 million. So assuming that same 10x purchase multiple, what was $10 million in cash flow is now 15, so times 10x exit multiple, that would mean that they sold the business for $150 million. So layering that on top of the $30 million in debt we've already paid down, now that equity check has grown to a value of $120 million versus an initial investment of $40 million. So last step, let's say, the cash flow has been growing, proving that this is an attractive company, and let's say it's a competitive auction, and we are able to sell the business not for 10 times cash flow, but for 12 times. So now our $15 million in annual cash flow times a 12x multiple is now a $180 million enterprise value sale. And again, we only have 30 million in debt left. After the 30, we have paid back. So our equity check is now worth 150 million. So this is an example of what things look like when things go well. That represents a 3.75 times return of the initial equity check of 40 million. Again, that's a great outcome. And just to highlight the power of leverage here, if you compare that to what the return would have been if we didn't use any debt, we would have bought the business for 100 million and sold it for 180 million. We would have only earned a 1.8 times return on our equity. So you see the return is more than double because we were able to use third-party leverage. So that's an example of what a typical deal looks like. And as you'll see, the common career path here is to go into private equity after investment banking. And you'll see a lot of people are excited to move from investment banking into private equity for a number of reasons. The biggest, in investment banking, you are fundamentally providing customer service, client service. You are working for other companies that are buying and selling other companies or raising capital. So, part of the long hours that investment banking is known for are due to short-term, immediate need client requests. A client calls on a Thursday or Friday and says they want to start preparing a bid to go buy another company over the weekend, say, as an extreme example. Private equity, you get a lot less of that because you, as the private equity fund, are in control of what investments you make, what companies you're looking at, things like that. Private equity is also a higher risk, higher reward industry in that you are actually investing the money yourself. So again, investment banking, you're providing client service for a fee. In private equity, you're actually investing capital, which means you can make more money on that capital if investments go well. But again, it's high potential for higher reward because it's higher risk. If you invest money, you can also lose money. So it is a bit higher stakes in that sense, which can be very rewarding. There's more on the line, and it's just a generally higher risk, higher reward activity than banking is. And probably the biggest one at an analyst or associate level, one of the cool steps in moving from banking to private equity is you really get a broader scope of experience working with companies. Investment banking, you're really just doing the financial analysis required for mergers, acquisitions, and raising capital. Whereas in private equity, you really are responsible for everything that impacts a company's value. So that involves a lot of market analysis. Is some new market you're looking at attractive? Is it growing? Who are the competitors? Things like that. You will look at a lot of things that may not even seem at all related to financial analysis, because those are the things that really drive company value. So, even at a junior level, it is a cool step because you learn, again, everything that's required to be a good investor, to analyze are certain companies, certain markets, attractive areas to deploy capital. So you learn the basics of managing a capital structure, raising debt, making acquisitions, selling companies. But again, you do cover a lot more than just the capital structure, financial engineering side of things, which is pretty cool. So how do you get there? Is this a job you can get out of college? What does it look like? So the private equity career path is pretty well paved. The first step, it is not typically a job you can get directly out of college. The vast majority of cases of the path in start with doing 2 to 3 years at an investment bank out of college, completing the analyst program at one of the big investment banks. A lot of names you're probably familiar with: Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, Merrill Lynch, some of the bigger ones. And then it is from the analyst program in these banks that you then take the step into private equity. There are a lot of recruitment firms that bridge that gap. They'll actually typically start calling you not much more than 5 or 6 months after starting your job in investment banking. They'll start to line up interviews, sessions to get to know you, and then the recruitment firms will patch you through to the private equity firms for interviews. So it's not uncommon to be signed on to your private equity job within a year out of college. So you'll only be one out of the 2 years, say, in your analyst program, and you'll have already signed on to a private equity job in a lot of cases if you choose to go down this path. So it happens very quickly. It's very competitive. And it is kind of wild that you do not benefit from a full 2 years of work experience before you have to do these interviews. But for better or worse, that is the construct of how it typically works. So there you will complete a 2 or 3 year associate program at these firms, and then they will typically make you go to business school to get your MBA before coming back as a vice president and getting on a partner track. So, if you look at people at private equity firms, the vast majority will have gone to one of these 3 business schools: Harvard, Stanford, or Wharton. Again, another pretty competitive step of the process, but it's pretty well groomed for people that are going along this. So, and again, that's not to say there aren't other business schools that have supplied a number of people to private equity, but these are names you will see a lot on this path. And then after that, you'll typically go through another recruitment process coming out of business school to go back into a private equity firm at a VP role. And then, it's really after business school that you'll be on the longer term track in one of these firms. And one note, what's cool, if you do peel off from this path in any way, you'll typically have a lot of cool options that it may be harder to see while you're a student or even an analyst or associate. There's lots of cool opportunities coming from banking or private equity to go work directly for a company, maybe a portfolio company of one of the private equity firms. I did that for a few years. Was a really cool experience. And even, technology firms now are often recruiting people with this type of background. So there's lots of cool ways that you can peel off, as well as people understand that you're going to work really hard for these first couple of years out of college and really develop a good skill set. So hope that was helpful and in understanding what private equity firms do and what a career path in that industry looks like. Thank you.